Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in.
So data. We talk about it all the time, continue to talk about it. But there's, I think the last short we talked about employment, we talked about permits, and now there's even more things to consider when you're looking at this John Burns report. One is the number of projects being started, and then in any given period, but also not to mention the number of projects that are sold. So new construction that's been sold. When you look at John Burns, I know you're going to say yes, but just tell the audience, why do you look at housing started and completed, knowing you're not buying a new home?
Again, like these are just leading indicators, right? So these are like the indicators in a market that'll tell us what the future might look like, right? And so if I can keep tab on the leading indicator, and then I've got a pretty good signal on like what's going to happen in the future. And again, this is all just based on what's happened historically. We've had weird stuff happen, right? Yeah. I feel like ever since COVID, the world is weird, right? It is weird. There's just weird stuff that goes on, or we have to almost account for the weird now.
Yeah.
But the reality is with U.S. national housing starts as a statistic, what you're looking at here is you're really looking at, the sectors one. That's a good indicator, right? So the way that they break it out is by manufactured housing starts, right? Multifamily housing starts, and then single family housing starts. Three totally separate groups, right? And three different demographics in the United States are being shown here of what's going on. Usually like the biggest one is single family. You see the most single family starts. That's kind of the most desirable asset class. Your median price point, that one works. What we saw over the last since COVID, right? Or maybe even before COVID started, is we saw a really high percentage of multifamily starts. And what that told us is that maybe there was a trend to were people trending away from buying single family homes and moving into multifamily housing. Now, in our particular, this most recent use case, it was that plus the access to capital to multifamily housing became very, very easy to get.
Right.
And it brought a lot of multifamily development into markets, and especially redeveloped areas. A lot of that was done with, in the last administration when we saw the opportunity zones. So you saw a lot of multifamily projects jumping into opportunity zones. You and I toured the one cul-de-sac. That's in an opportunity zone, multifamily project. I mean, it's the perfect. That's exactly what we're talking about here. So there are things that you can look at in a market based on where these starts are. And I think the biggest thing is you want to make sure that there is starts. And so like last year or 2024, we're almost at the end, housing starts across the board, right? All three sectors was down by 8%. Right? And what that means is so that challenges employment, which we talked about. That challenges home affordability because now housing becomes even more scarce. Our population grows. And if we don't keep up with that, now homes become less affordable because now there's the demand for them and people are stretching to buy those things. So that becomes an issue. I think housing starts is one to definitely keep an eye on. What's cool about this month's report is, they're showing it out to 2027 again, and they're showing a very consistent increase in the number of housing starts year over year. That's comfortable. I remember a time in 2006, 2007, as I was just kind of kicking off my real estate, journey, home prices were appreciating so fast that builders could not keep up with this, right? But they were building like crazy, right? So you saw the number of housing starts go absolutely berserk. Well, what didn't follow it was employment, right? And jobs, like all of those things, like they didn't follow suit.
Right.
So as a result, we ended up with an oversupply
Yep.
and an under demand. And now you've had an inverse market. And that's when we saw that massive recession
Yep.
as a result. I mean, there's other factors that led to that, but that's a big deal. You know, that one was huge.
Yeah, so you start to see a uncertain economic, right? They start to stress out thinking there's going to be affordability issues and other things like that when that happens. Yeah. So it sounds like this is a very crucial dynamic data point that you need to consider. Yeah.
Yep. Yeah, I mean, you see it like, you know, if you were to watch a ticker, CNN, MSNBC, any one of these, right? Housing starts is typically something that's on there. Like they're talking about it quite a bit because it leads to so many things,
Yep.
right? There's just so many things connected to the real estate markets in general that housing starts, like I said, is just an early indicator of what that future is going to look like.
Yep.
And you can do it again, like on a macro level. You could do it on a micro level in a neighborhood or in a subdivision or in a zip code. You know, I think you should be looking at all of it.
Yeah.
Right? Critical. It's important for sure. The other one that I think is important to talk about is single family home sales.
Okay.
Single family home sales is always a solid indicator of like the strength of the market. And you know, when they mark this, they're marking it in, you know, millions of sales. Like we saw less than 1 million sales last year or this year in real estate. You know, like residential home sales, less than 1 million homes traded hands.
Wow. The lowest in a long time.
Like 30 years.
Long time. Yep.
Yeah. Like 30-year low. And the reason that is, you know, obviously we had record high interest rates and they were going up. So unless you had to sell, it didn't really make a lot of sense to sell,
Right.
you know? And what was weird about this market that we hadn't seen ever either is we've never really seen where the number of home sales was decreasing and property values were increasing and rents maintained the same. Like those three factors typically aren't running in that scenario. You know, you might have a market where you see home sales pacing and home values pacing. In that scenario, typically rents are pacing as well. And you'll get that same pace with those. But for the first time ever, we saw a world where rents were maintaining, home prices were going up, and the number of sales were going down.
Interesting time because everything feels strange. I don't know if these correlate, but this is the most equity folks have ever had in a long time.
Yeah.
But then I also read this is the most credit card debt that anyone's ever had. Is there some correlations there as well?
Oh, yeah. Big time, man. Yeah. I mean, that's a big deal, right? I mean, equity is an interesting topic alone in itself. It's just like, you know, access to equity has a cost.
Yeah.
And that cost comes either like you got to sell your house to get it, or you have to get a home equity line of credit to get it. If you get a home equity line of credit, you're adding more risk to your home, right? So you're adding some of the risk to your home. The equity that you had is now being used for something else. So use it wisely, use it to invest, do something with it. Don't just use it to go buy cars and watches and things like that. But if you do those things, then, you know, you can really get yourself into a pickle, you know? And so, you know, equity's got I think consumers just have an interesting relationship with equity. You know, it's like we all have it and we all are like, oh, we've got equity in our house and we feel wealth as a result of having it. But when it goes away like that, right? It's gone. But it's not like our money that we earned. It's money that we passively got through just owning real estate. And so I think our relationship to it is just different as a result.
Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.